John, we are seeing a major change on Wall Street, which happens in good times, with the freeing up of retail can buy sophisticated products. And of course, it comes down to the access to private equity, the access to hedge funds, as years ago, the access to private tax shelters. Are we heading for trouble?
Oh, I actually think this is a good development, Tom. And what's prompted the discussion about private equity and individual investors is the SEC's decision recently to expand the definition of accredited investor, which in the past has been tied to income levels and net worth, and add modestly. This is not opening the barn doors, but add modestly to the types of individuals who can access private equity. And that followed on the heels of the Department of Labor allowing private equity allocations in 401k plans earlier this year. Now, the way I look at this from a policy perspective is just expanding, as you said, the options available to individual investors, access to more investment opportunities in a period when cash is zero, bonds are zero, and stocks are fully valued. Obviously, there are risks, but I think the opportunities outweigh those risks.
John Taft, I want to talk about the x-axis, which is the liquidity found in the stock market, even the liquidity found in selected intangibles. Where's the liquidity in private equity? I don't see it.
Well, okay, that is one of the single most important considerations for individuals considering an allocation of private equities. It is an illiquid holding. It takes about 5 years for fund managers, if you decide to go into a private equity fund, to invest the money that you give them. And then it takes another 3-5 years, possibly longer, for them to harvest those investments. So you're looking at holding periods of up to 10 plus years. And that's an important consideration. That is not the type of investment somebody who thinks they might need cash a year or two from now wants to make. But in return for that illiquidity, Tom, you get a premium in return. And let's not forget, half the economy is in privately owned businesses, not reflected in the public market indices. And until now, that opportunity to participate in that private market was restricted to a relatively small group of individuals.
John, what if our economies change pretty significantly in a way that we weren't expecting? What if loans increase significantly? What does it mean for some of the private equity investments?
Well, I actually think that private equity investors. Now, what we're talking about here is professionals who put together funds, and then we're talking about individuals investing in those funds. So we're talking about a diversified set of investments from the get-go, which is important. But I actually think handing your money over to professional investors who can be agile and adapt to changing market conditions is the way to go right now in a world where many of the rules that undergirded our economy for the last decade or two are being rewritten. So I think this makes a lot of sense. Let's not forget, Francine and Tom, that this is not a new development, increased allocations to private equity. The smartest money in the world, institutional investors, have been building up their private equity allocations for years in search of returns in order to meet whatever liability targets they have. So all we're talking about now is making that type of opportunity available to individuals in a market where other investments, quite frankly, aren't that compelling.
Yeah, what I was trying to get at, John, is how this health crisis will actually change our companies forever. Right. So you look at the stock market, you look at the economy, they're pretty solid thanks to the unprecedented stimulus from the Fed and other central banks. But once that goes away, what kind of economy will we actually be left with?
Well, if you're asking how will the market respond, we have, as you point out, been buoyed by shock and awe monetary policy, shock and awe fiscal stimulus. And if we want the market to stay at these levels and behave, then we're going to have to continue doing that. So that's one thing. The second thing that you talked about was how is the economy going to respond to the health crisis? And the point there is eventually we'll get to the other side of the coronavirus pandemic. The market is anticipating that's going to happen in the middle of 2021. We think it could take a lot longer than that. And we also think that there are going to be, and maybe this is the point you're getting at, permanent changes in the way people approach work. I don't think we'll ever have a return to the type of in the office workforce presence that we used to have. Now, is that a good thing or is it a bad thing? Truth is, it's good for some sectors of the economy and some businesses, and it's not good for others. Private equity investors are agile and can adapt to that, just as public market managers can adapt to that. So I really don't see any difference in the risks you're taking by allocating funds to private equity when it comes to the permanent changes we're going to be experiencing in our underlying economy.